Namaskar. Hey all that glitters is not gold, they say. However, gold is now glittering at record highs of nearly $2,950 an ounce. It has gained over 12% since the start of 2025. The adage of gold glitters should suit paper gold more. Wondering why? Let's see what's happening across the world and the trouble ahead. Gold refineries have now begun to charge a temporary surcharge for delivering gold. According to Singapore-based Bullion Star, Metalor, one of the leading Swiss refineries, has introduced a per-ounce surcharge on all its gold products. This is due to shortages increasing the gold lease rate, the widening spread between spot and futures, and tariff-related factors. Another Swiss refinery, Argor Heroes, has suspended orders for all 50-gram and 100-gram minted gold bars. The refinery is imposing an extra fee of $3.5 per ounce of gold and $3 per ounce of silver from February 20. This is because of unprecedented demand for physical gold from the US Commodity Exchange or COMEX and speculation over the potential Donald Trump administration's tariffs. This is delaying the delivery of the precious metal by London's vaults and refineries. The waiting time for London gold delivery is between 4 and 8 weeks. Gold shortages are being reported in countries such as China and South Korea. This has resulted in a rise in the spread between spot and futures gold. At one point in time last week, when spot gold price was ruling at $2,943.2 an ounce, the continuous futures contract was quoted at $2,957.4 an ounce. Traditionally, the spreads are narrow, but they increased to $60 at one point in time before dipping to around $15 currently. A major reason for the rise in the spreads is a substantial flow of physical gold from London to New York. The Discovery Alert website says concerns are mounting over the availability of physical versus paper gold claims. However, Ross Norman of Metals Daily Limited says claims of physical shortage are exaggerated and rooted in logistical challenges rather than actual scarcity. Institutional demand for gold from the US, particularly for COMEX deliveries, exceeded 200 tons for February. Over the past 2 months, the demand for deliveries has been about 500 tons. This is because traders are capitalizing on lower spot prices in London and higher future prices in New York. Gold clearing banks JP Morgan, HSBC, UBS, and ICBC Standard have depleted their available physical gold for delivery. They are depending on the Bank of England for the yellow metals delivery. However, the Bank of England seems to have exhausted its stockpile. The opacity of the London Bullion Market Association (LBMA) is blamed for the current situation. Bullion Star says the LBMA lack transparency, providing no public access to order book volumes or trading data. Analysts say spot gold is being treated as a currency without any backing of physical gold. LBMA itself does not hold gold reserves and relies on its members to provide delivery. LBMA has been charged with the proliferation of unallocated synthetic paper gold, allowing banks to trade the precious metal without actual physical backing, distorting price discovery. Analysts estimate that for every ounce of physical gold or silver, between 100 and 600 times more of the precious metals have been sold in the paper form. Now, with the US seeking physical deliveries, the paper-based system has come under pressure. If only a small amount of those holding the metal on paper demand physical delivery, the entire paper market will collapse. That's something investors in demat form will have to be wary of. Exercise caution. Buy physical gold if necessary. Keep smiling and be happy. Until we meet in our next episode, this is Subramani Mangambu signing off. Bye all.